For those of you who don't know, I teach both at Lifelong Learning. I teach adults. Some of you in here have been my students. Some of you are my students. In addition, I also teach at USF Sarasota Manatee. I teach undergraduates financial analysis. And I write 7 newspaper columns a week and have been since 1998. Never missed a column. So I stay a little bit, because I also run a money management business. And I'm finishing up my doctorate, in which what that should interest you only for one point, and that my dissertation proves that some of what I'm going to teach you today works. Professors didn't believe it. I showed them my initial draft. They said, no, you got to do this. I did that. No, you got to do this. Did that. No, you got to do another model. I said, that's your last one. Came back. They said, no, you're right, Loren. What you said works. I said, thank you. After 50 years, I have some idea what I'm doing. But how many people do you know who start their doctoral program at the age of 69? My friends are all playing golf. I can't play golf, so I figured I'd get my doctorate instead. Okay, and people keep asking me about my book. I apologize about that. The book is 3/4 written. It's been 3/4 written for a while. The difficulty is the dissertation took precedence. And when I walked into the program, I did not realize that a dissertation took as much time as it takes, and that teaching takes as much time as it takes, and running a business takes as much time as it takes. And one day I go home and, my dogs don't recognize me. My wife doesn't recognize me, so I got a small problem in my hands. In any case, what I'm going to do today is I'm going to take you through some concepts about what's happening on the world as it affects Wall Street and what I recommend that you do. Now, this session is being recorded. So, let me make it very clear, in case there's some lawyers in the room. This is for entertainment purposes only. I am not trying to get you to buy, sell, stand pat, or do anything. My purpose today is to educate you, and that's it. I don't sell anything. I have nothing to sell. Yes, I'm a professional money manager. That's quite well known. It's in the paper every week. But this is this is what I would teach my students, what I'm going to tell you. One last housekeeping item. We are doing a financial cruise. It leaves towards the end of February this year, down the Caribbean. It's about sold out. We're going to do another one in 2019. The first one I couldn't pick the ship, the location, or the date. The next one I picked all 3. And we are going to go, it's already been arranged, we're going to go to start in Rome, and we're going to end in Greece. And we're going to spend 3 days in Israel. For any of you who are Jewish, we'll be in both Tel Aviv and Jerusalem. So you don't stop there, because those are both landlocked, but you all figured that one out. But we will spend 3 days in Israel. So if you're interested, let me know. I'll tell you that if you bought cabins, when we first announced it, we announced it back in 2017 for this cruise, it was about $2,000 a person. Today, it's $6,000 for the same cabin, on the same ship, same cruise. So it does pay to reserve early. Okay, now for the commercials, let's move ahead and see what we can do today. All right. What we're going to discuss, we're going to discuss the economy. The stock market is driven by the economy. That's rule number 1. We're going to talk about Wall Street and the environment in which it operates. Now let me start off by telling you that there is no human being on this earth that can tell you what the stock market is going to do, what Wall Street is going to do in an hour, in a week, in a month, year. You take your time period. If they tell you they can forecast it, they're lying. Okay? It's very simple. They're lying. Or they're totally ignorant. Take your pick. I'll give them the benefit of the doubt and say they're ignorant. You cannot do it. We don't attempt to do it. Do I watch the market? Yeah, of course I watch the market. Because clients come in, they expect to see the market on the wall. Yeah, it's there. It's clicking right away. See, it's over there by the wall. But we do watch companies. We cannot, you cannot, no one can forecast the market. What you can forecast is corporate performance. And if you do some of the things I want to teach you, you can do that with a high degree of accuracy. That is how you make money. Now, some things I'm going to teach you today go against everything you've heard. People will tell you, you talk to a stockbroker at Merrill Lynch or somebody, oh, Rudd, he's nuts. He doesn't know what he's doing. Well, after 50 years, I do have a little bit of an idea what I'm doing. So we're going to do the methodology on the Wall Street process, the investment process, and I'll give you some companies I like. So let's start off with the bear scare. Every day, people call me, Warren, when's the market going to crash? Well, let me check my watch. I think about 4 hours and 27 minutes. Oh, by the way, how do you define a crash? What's a crash? I've yet to get a definition. I mean, you can tell me 1929, 1934, 2008. You'll see that's not really a crash. As some great man, I don't know, it was War, I forget who did it, but he said, more money has been lost preparing for a correction that was ever lost in a correction. Wall Street is volatile, as you'll see. No argument about that. But there is no need to panic ever. Yes, people are going to try to get you to do it because they want you taking action. That action will make them money. So, are there bears around? The bears are still lurking. Of course they are. This slide is compliments of Goldman Sachs. I thank them. They don't know I used it, but it is a compliment of Goldman Sachs. People constantly say to me, Lauren, you're always a bull on Wall Street. I've been a bull for 50 years. Never been a bear. Always believed there were opportunities on Wall Street to invest money. I'm second generation of business. I basically grew up on Wall Street. It's the only thing I know. I can't fix my car. I can't paint a room. Don't know how to vacuum. Oh, thank you, dear. See, she recognizes me. However, I will say I do know a fair amount about investing. And I try to impart that knowledge to anybody who wants to listen. Now, to me, the glass is always half full. It's never half empty. Now, you're going to hear what's my opinion. Okay? Some of it's found in books, but basically what you're hearing is what I believe. It may not be a fact, but it's my perspective on Wall Street. However, as I've learned, listening to people, it's much easier to be critical than to be correct. Now, what are you going to face going forward in 2018? Well, you're going to have an environment of high volatility. There's no question. There's always volatility on Wall Street. It's how you make money. Volatility is there. There's going to be great policy uncertainty. You never know what's going to come out of Washington, D.C. on any given moment. I mean, I don't care. 3 o'clock in the morning, you get a new policy statement. I didn't know they do it on Twitter, but I don't have a Twitter account. I mean, my firm uses Twitter, but I don't. I'm still working on email, okay? I got the texting down. My wife showed me how to do that. I'm old school, you know, black phone with a dial. So, we have geopolitical tensions, and we have a lot of them. And they're also going to affect the street, but they may not affect the corporations you invest in. And we have somewhat of an unconventional presidency, and that's as far as we're going to go on that one. Okay. Jeremy Siegel, he said 23 years ago, stocks are the best long-run asset. I'm going to refine that view, and I'm going to tell you that equities are and will continue to be the best investment asset. We only invest in equities. A small group, but only equities. No bonds, no mutual funds, no ETFs, no hedge funds, no whatever you want to call it. We don't do it. I have done it. I know how to do it. I'm licensed to do it, but I'm not doing it. Now, this is one of my favorite little sayings. First, you have to learn the rules of the game. But then you have to play better than anyone else. And that's what we try to do. We try to play better than anyone else. And that's my favorite person, Albert Einstein. If you come to my office at home, you'll see a 3 by 2 foot picture over my desk of Albert. Okay, we're going to start with the economy, because the economy is the underlying force of what happens on Wall Street. Now, unemployment. Unemployment has come down. I don't care who's the president of the United States right now or who was the president of the United States. Doesn't make any difference. As you can see from this line, this thing right here, you have the crisscross, the hatch thing was a recession, and you can see what's happened to unemployment. It's come down. Now that is a good thing up to a point. Up to a point. I'm going to discuss a little bit more in a couple of minutes, but unemployment could be a tiger in a bag that you don't want to let out. Okay? We're down to 4.1%. A lot of forecasts are calling for mid-threes by mid-part of this year. That could be a problem. I'm an economist by training, and I will tell you that could be a problem. Now, there's three types of unemployment numbers. The bottom line on there is what you call your standard unemployment. Then you have U5 and you have U6. U6 includes people who are looking for a job, people who are marginally employed, people who can't find a job. It is the most realistic number. However, as you can see from the screen, that's down to 8.1%. That was way, way higher before. It was as high as, I'm hard, so I can't see read my screen here, but it was considerably higher. It's come down. Unemployment is doing fine. When I drive to work, I see trucks, pickup trucks, they have signs on them, we're hiring. You drive by businesses, we're hiring. The problem is there's not enough labor, to be honest with you. And there's a reason why there's not enough labor, and there's a reason why it's going to get worse. Okay. Unemployment goes up, it goes down. And as you can see, you can see on things, yes, during the recession it was way up, it's been coming down, it will stay down for a while, but that will change, okay? It will change. Payrolls. Payroll numbers have been quite high. We've had a lot of jobs created. The thing is, you can see it has slacked off a little bit. The line in the center is basically zero. The gray stripes are recessions, and you can see what's happened. I don't think this thing does a, oh yeah, it does. See this? Okay. That's the recession. We came back up. You see things have flattened off a little bit. Why have they flattened out? Why have we not created as many jobs? Because we cannot fill them. That's why. There's not enough labor to go around. Now think to yourself as we go through this, what happens when an item becomes scarce that you need for production? In this case, labor. You have to bid up the price, correct? Well, what do you think is going to happen? We'll get to it, but you can think about that for a minute. Because if you look at, this is the hourly wage rate. Now, it looks like a fairly steep, oops, my mistake. What the heck? Give me 1 second here and I'll figure what I did wrong. There we go. Okay, hourly wage rate. I shouldn't play with toys. It's a fairly steep line, but look, the numbers are not that great. But wages have been increasing, okay? The question is, at what rate of increase will those wages continue to increase? Once again, think about factor of production. You need labor. Well, it used to be people were scared to leave their jobs, and they would take any wage rate you offered them. That was during the Great Recession. Not the case today. Workers are saying, hey, I can get a better job. I was working at a menial job. I get a better job, and I'm going to ask for more money. And I'll probably get it, depending on what part of the economy you're in. If you're high tech, you're sure is going to get it. Even the medium level jobs are getting it. Even some low level jobs are getting it. Now, there's been a large transfer in jobs, a lot less blue collar, a lot more one step up, and a lot more in high tech. But we can't fill them. I think Intel has like 1,000 jobs they just cannot fill. There's nobody to fill them with. Change in labor costs. Here's what's saving the economy right now. Labor costs have come down. Now they're starting to rise. But think about what happens if you get something like this. Potentially a problem. Potentially a serious problem. This is where we are right now. For the record, I don't want people getting scared. You're okay for a year, maybe 2 years. But if you're looking out into 2019 and beyond, word of caution could be in order. Because this little thing called inflation could start to raise its ugly head. Now, there's various types of inflation. You can see from the chart there, the Fed uses PCE. The published number in the newspaper is CPI, Consumer Price Index. The personal consumption expenditure is a different type of calculation done by a different group. These slides will be on my website, by the way, and you can reference them. You don't have to, if you can't see it, I mean, you might want to read. I described to you exactly what the difference is between these. So CPI is what you're used to seeing. Now, CPI came down last reading. But the question is, will it start to raise its ugly head? For the record, over the past 40 years, the compounded annual growth rate of inflation is 3.2%. We're sitting right now at about 2.2. The Fed would like to see it a little bit higher. But ask yourself this question. What will the Fed do if inflation starts to rise a little higher than they expect? They're going to raise rates. That's correct. You see, it's like a faucet. You got the water running out, and if you get too high a flow of water, what do? You turn back the faucet, and you reduce the flow. When you reduce the flow, you slow down the economy. What's next? Recession. Not today. I'll show you the charts. But 2 years down the road, if we keep going down the same path, it's a possibility. I can't forecast at this point. I can't forecast 2019. I will forecast 2018 right now and tell you it's going to be a good year. And as I tell my clients and my people come to my office, as far as the stock market's concerned, when the cookie tray comes around, you grab a few cookies because they may not come around again. Keep that in mind. Okay, monthly CPI change. Not quite up to date, but very close. CPI change. Okay? You can see it fluctuates. Had a spike, had a spike, had a spike, came down. Everybody was really lackadaisical about it. But now look at this. You've got to keep your eye on the economy. It's more important than keeping your eye on the stock market. Because how the economy goes depends on how companies go, and as company goes, that's how their share prices go. A follows B follows C, and it does not work any other way. And if somebody tells you, well, this corporation is going to do this, or this market's going to do that, and we should be buying here, and why? Always ask why. Show me the numbers. I will tell you right now, I do everything mathematically. I'm an amateur mathematician. Everything we do in our office is mathematical. Emotion does not enter into it. My wife will tell you, according to her, I have ice water in my veins. I don't care if the market's going up or down, there's always opportunity. Market's going down, guess what? I'm going shopping. I don't walk into Macy's and say, you see a sweater for $40? Call me when it goes to 50, I want to buy it. No, I said, call me when it goes to 20, and you got it on clearance, call me, I'll come in and buy it. Well, maybe nobody wants it. I want it then, okay? Warren Buffett, bless him. I went to hear him in, where did I go to hear him? Omaha. I had to find it on a map. First I had to find Nebraska. Didn't get out there too often. Like that was the first time. Then you say, you're here for the meeting? I said, meeting? Yeah, the meeting. That's what they call it. I said, yeah, I want to hear Warren Buffett. Guy's a genius, by the way. Anyway, he made, between 2008 and about a year ago, 6 months ago, he made $12 billion buying in 2008, 2009. $12 billion. which, by the way, right now to him is getting to be pocket change. So the guy he's by his own, listening to him for 4 hours is amazing. He has more money than he can spend. I mean, talking about for investment purposes. He can't find enough things to invest in. He says, if he finds a company, he writes a check. He said, most people like to play with railroads. He went and bought a railroad. He didn't play with it, he bought the whole railroad. Okay, here's the monthly change in the PCE. This is the one that the Fed likes, okay? You got the same type of reaction here. And by the way, the Fed notices these things. Now I'm going to quote to you from a couple papers in a minute from the Fed. They're paying attention. Okay, let's talk a little bit about interest rates. This happens to be the 10-year Treasury. 10-year Treasury is considered to be a risk-free asset. Why? Because Uncle Sam's going to pay you. No matter what happens, you hold a 10-year Treasury note till it comes due, and Uncle Sam's going to give you $1,000. Period. He can print money. It's considered to be risk-free. But it fluctuates in price. But it's a pretty good indication of where interest rates are going. And interest rates are starting to creep up. They were very low, starting to get higher. Now, is the Fed going to raise rates? They're talking about 3 rates in 2018, 3 raises. I would say 4 could very easily be on the plate, because I believe inflation is going to creep a little faster than they had in mind. And they're going to have to react. I hope they don't. I have no way of knowing. It's just that I have this uneasy feeling that rates are going to start to move up because wage costs are going to start to move up. So, not a bad thing. Nothing's wrong. We're getting back to normal. The normal rate on a 10-year Treasury is about 5%. Historically, stock performance has been generally not negatively impacted by raising interest rates until the yield on a 10-year reaches approximately 5%, almost twice as high as today's level. So what are you going to do? First of all, you're going to keep your eye on inflation. You're going to watch the PCE and the CPI. They're published in the newspaper. That thing comes to your door if you happen to subscribe to it. It's about this big. It's got print on it. Okay, it's not the internet. You can get it on there too. Both numbers are published. Interest rates are published. It's all on the internet. And if you happen to be addicted to television, God forbid, you'll see it on CNBC over and over and over and over. I used to keep CNBC on all the time. I always had it on mute though. Always on mute. I just wanted the stock ticker. Well, I got Bloomberg's in my office now, and I'm putting in a stock ticker in the wall, so I don't have to worry about that anymore, so TV stays off. Okay, I had 2 people already come up to me asking me about crude oil. Crude oil has been a bit of a problem for many countries. Price dropped, as you know, from about 120, got down as low as $40 a barrel. I forecasted a couple of years ago that it's going to sit around $40 a barrel. I said we could go to 50 about a year ago. Right now it's around 60. Will it continue at that rate? Will it continue to rise? Well, here's 2 factors that will determine it. First of all, OPEC and some associated other countries are cutting back on production, about 1 million barrels a day. That's one thing. And during the recession, the Great Recession, a lot of the people who were doing the shale and so on type oil, they went out of business. Because at $30 or $40 a barrel, and remember, $40 a barrel, that's market price. That's not coming out of the ground. You're getting about $20 a barrel at that point coming out of the ground, maybe $28 a barrel. They couldn't survive. Well, things have turned around. And they're drilling more wells. They're doing more offshore. And supply is increasing. So the question you have to ask yourself is, will the supply get ahead of demand again? If it does, oil price is going to come crashing down again. Or will the supply be better monitored to an extent and then get the price back up? Here's why the price is so critical. Russia and Iran There are a couple of South American countries, but the two key ones, Russia and Iran, their economies depend on $120 a barrel of oil. And they haven't been getting it. And Putin's in a real bad mood about it. Not that I really care, but he's in a real bad mood. Well, he makes life difficult. Iran does too. And there are other countries that would like to see oil up higher so they can probably try to get their economy somewhat back in shape. Although Venezuela is pretty much, I don't know, they're pretty much down the hill. Here's crude oil prices. Now you can see there was a little dip right about here, but they've been moving up over time. And if you look, this is WTI, that's Western Texas Intermediate. That's what we use as a benchmark. And then you've got Brent crude, but you can see this is North Sea. You can see it's pretty much done the same thing. They pretty much follow. Brent is usually about $1 a barrel higher in average quotations. But that's not the key. Here's the key. Crude oil supply versus demand. Now, if you look at it, you can see that the daily production surplus is a green line. Demand versus supply, and it's forecasted out for you, okay? And you can see it pretty much increase. Now you got, remember, demand is increasing, supply is increasing, but demand is increasing. If they get a little bit out of kilter, and you can see at the very, over here, demand's a little bit above supply. Well, you know what happens, basic economics 101. You want this, I got that. What I have is less than what you want, fine. I'll charge a higher price, and that way it'll get spread out to the people who want it the most. So, bottom line, yeah, crude oil prices will continue to go up. Would I be buying energy stocks right now? No. We haven't touched energy stocks for 2 years. And I'm not prepared to do it yet. Energy and finance we've stayed out of. And I'm still out of them, and I still don't trust it. And I'm a little concerned because they want to take more and more rules away. They want to kill Dodd-Frank. They want to go back to the old ways. Well, you know what the old ways bought us. They bought us a great recession. Hopefully we won't go back there, but I can tell you, human nature being what it is, we will. Because if you remember the movies about Wall Street, it's greed. Wall Street is driven by greed. Profit motive, if you want to be more polite about it. Greed to those of us who work on the street. Okay, what's the environment for Wall Street? Well, let's look at some Dow numbers and some S&P numbers, and you can see that the P is a little bit higher than some people want it to be. Every day I get phone calls, Lauren, the P of this, is it any good? Well, what am I going to do with one number? If you give me a string of numbers, I can do projections. I can do regression analysis. I can do all kinds of mathematical things with it. You give me a number, say the P is 16. Okay, well, is that good or bad? I haven't got the slightest idea. Not a clue. People tell me that the P of the S&P is too high. Oh, how, why? Well, because people told me on television that the P is too high. Well, wonderful. What are you going to do? I don't know. I came to ask you that question. I'm saying don't do anything. Don't worry about it. Price to earnings ratio is just a ratio. It's a number. Now, if you come to me with a corporation's PE ratios over 5 years on a quarterly or monthly basis, I can do something with that. I can make a projection. I can figure out a little bit about what's going on, but not with a number. And who cares what the S&P is? The S&P index, the S&P 500 I'm talking about, that's 500 companies. That's the good, the medium, and the bad, all rolled into one. We call it the market. It's a pretty good index for the market. I'd never buy it. I would never buy an S&P 500 index. You know why? Because how are you going to beat the index if you buy the index? Oh, you can't. You figured that out. Good. You can't buy an index and beat it. And there was an interesting question. Warren Buffett it's been publicized. He's buying stock into S&P 500 indexes for his wife when he passes on. And the question goes, well, what do you mean? I thought you're an equity investor. Why are you buying index? Well, because I don't want my wife to have to worry about Berkshire Hathaway stock. And besides, I'm giving it all away. So I'm going to I'll give her enough S&P 500 indexes that will carry her for the rest of her life, and that's it. He doesn't buy indexes. No. He doesn't. And another question came up, if you stop to think about it for a second, if everybody bought indexes, what about the market? What is the market? How can anybody buy an index, nobody buys stock? Well, how are you going to make an index? You didn't think about that, did you? Well, the guy who started one of the mutual funds, anyway, he was there and he talked. It's very true. He admitted that. He said, look, if everybody bought indexes, there'll be no market. But we're about 35%. He said, until you get 75%, you're not in trouble yet. You've got a long ways to go. To me, it's just another mutual fund that makes money for the mutual fund company. So, buy them if you want, but I can't see the point of it. All right, corporate profits. Corporate profits about 11.5% of GDP, close to an all-time high, well above the historical 9.6. Been higher than the current levels only 17% of the time since 1950. Corporations are doing well. What happens when corporations do well? What do? They raise what? They raise the dividends. That assumes that you have dividend stocks. If you don't, guess what? You lose in that department. But they raise dividends, and what else do? They buy back stock, right? That's the two things they do. And they put money in retained earnings. Now, I'm talking to a CEO of a major corporation, big corporation, very big corporation. Big corporation. He says, Lauren, after this tax program passes, and I think it passed, at that time it hadn't passed quite yet, he says, I'm going to have $80 billion to play with. $80 billion. I said, okay, that's great. You can buy lunch and tell me what you can do with the money. He did buy lunch. He says, first thing I'm going to do, I'm going to raise the dividend. What are you going to do that? I'm going to buy back stock. Then what are you going to do? Probably put it in the bank, retained earnings. Well, where are the factories? Factories? Lauren, in the United States, I don't think I'm talking out of school, 10% of my workforce doesn't show up any given day. 10% of my workforce doesn't show up. And you know what? If I go to Mexico, you know what I pay? 1/3 less. I pay 2/3 less. I pay 1/3 of the rate I'm paying the people in the United States. And you know what? They show up for work. Now tell me what you would do. I run a big corporation. I have shareholders. They depend on me to run the corporation in the most efficient way possible. If I can produce a good in Mexico for 1/3 of what it costs me in the United States and my workers show up, why am I not in Mexico? And by the way things are going, labor supply, if Trump wants to get the wall built, you have to hire Mexican workers. All right, a little bit about the indexes. S&P 500 index. People say the market's going to crash. Now, this is a fairly limited graph, but I can go back and get you one that's longer if you want. But what's that line look like to you? Yeah, there's dips. That's 2008. There's dips. Sure, there's dips. But over time, what happens? It goes up. It's about a 35, 40 degree angle. And it goes up for one reason and one reason only. Because corporations are making money. And why are they making money? Because the economy does well. Our economy is growing. When you get problems like this, they come about because the economy stops growing. Because we do something stupid and we get the economy in trouble. Now, when that happens, you know it's going to be temporary, because an economy our size and a country our size, with the wealth we have, is a temporary situation. It's painful for a number of people. There is no argument. There's no argument. But for the majority, and over time, you will prosper. Here's the three indexes. You can't see that very well, Skip, but there's three indexes. Basically, they show you the same thing. I don't care which index you pick. They're all going up. Okay, one's NASDAQ, one's the S&P 500, one's the Dow, and one is the 2000. Okay, let's talk a little bit about market crashes. In 30 years, 9 market declines rate greater than 5%. 9 daily declines. But less than 10%, none in the past 9 years. You see, things weren't as bad as you thought. There's a graph of it. The Dow on the right, the S&P on the left. So look, this is 2008, the bottom line here. Not a single one. Here's a 10% line. Not a single, oopsie daisy. I gotta stop playing with this thing. Oh. There you go. This is 30 years on here. 30 years. Now, why are you so worried? Where's this vacuum cleaner phenomena where it sucked up your dollars? It doesn't do that. People have no idea what the market actually does because they don't read. I don't care what format you read in, but read. If you listen to the talking heads on television, they don't know you. And they usually don't know what they're talking about. I don't care who they work for. Let me tell you a little secret. Every single human being in the United States, or actually in the world, who's interested, gets the exact same information on any corporation in the United States that trades at exactly the same time. We all get it all at exactly the same moment in time. Carl Icahn does not get any information that I don't get at any particular time. And he may have 600 people analyzing. I don't know. I don't know why Carl Icahn. Never met him. Pretty good investor, however. But we all get the same information. It's all published at Edgar. Edgar is a government site where you can get information from. And corporations are required to supply digital format stuff to government. It goes up in Edgar in 24 hours. And every single time something goes up, at exactly the same moment, we all learn about it. So nobody, people walk by office and say, well, you're a small guy. We talk about height or money under management. Or both. I said, look, I have the same information everybody else does. I just don't track 600 companies. I don't track 100 companies. Maybe 70. But I have all the information they do. It's a question of how you analyze it and the conclusions you draw. But nobody has an advantage over me in terms of information. It doesn't exist. It's called FD, fair disclosure. Talk a little bit about recession. Here's a big money management firm. They did an analysis about potential recession. Dotted line is the forecast. We're down in here. We're down very low. However, this is what they're forecasting. They think it's possible. And it is possible. I won't say it's likely, but it is possible. Forewarned is forearmed. It's a little hard to read, so I'm going to sort of skip over it, but it shows you exactly, like I can't read my own slides here because I use a very small thing on here. So we'll skip it and we'll get back. You can look at it on my website. Expansions. People keep telling me the expansion can't continue. I said, why? They said, well, go up, it's got to come down. I said, why? Well, because everybody says it goes up, it's got to come down. Why? Getting tired of asking people why. Don't tell me something's going to happen. Tell me why it's going to happen. I want to see numbers. I want to see projections, statistical analysis. Well, Joe on television said it's going to come down. Well, you told Joe to call me. Look, the red line is the current expansion. We've got two longer. Where is it said that this thing's got to crash? I still don't have a definition of crash. It doesn't. It can keep on going for a long, lot longer. 50% more. No problem at all. Here's the probability of a person dying. I threw this in because I'm 72 years old, almost 73. I was checking out the graph. Probability of dying in 1 year, depending on your age. Actually from actuarial tables. I said, well, I got a ways to go yet. Diane, don't worry. More to the point, here it is for post-war probability of recessions. Age in months, you can see where we are. What's the probability? You're still way down low. You're still under 5%. So what's all this talk of recession? Could it be coming? Sure it could. But not tomorrow. And you're going to have plenty of warning. By the way, those of you who think 2008 just came out of nowhere, you're very much mistaken. Those of us who paid attention, and one thing about being a newspaper columnist, you can go back and see what I wrote. You can go back 30 years if you want to see what I wrote. I told you dot-com era is going to come to an end. I told you Enron was impossible. I didn't tell you about one particular Ponzi scheme I knew about because I didn't want to get sued, but I tried to warn people, they wouldn't listen. They got burned. And I said 2008 was coming. It was coming. It had to come. I wrote it in my column. I said, here, read it. I'm telling you. Go do your own research. Because I keep saying, every column I say in the end, I say, do your own research, please. Nobody does. Empirical evidence indicates that expansions during the last 70 years do not become progressively more fragile with age. They don't. Evidence supports the view that the current recovery is not living on borrowed time. Expansions like Peter Pan endure but never seem to grow old. Okay, here's something I'm a little concerned about. I had a couple clients come in, a couple actually prospects, and they're telling me about momentum investing. Momentum investing is what you do is basically stock is going up, so you jump on it. Try to ride the train for a little bit longer, okay? It's basically a fairly speculative way of investing. I don't approve of it. I don't do it. A lot of people do. And there's a couple things that in its favor, and one of them is the trend is your friend until the end. Yes, I agree with that. Till the end. And let your winners run. I do sort of like that too, up to a point. What bothered me was this graph, because the top line is basically shows momentum investors or a little bit of speculation as opposed to just a straight index. It's an MSCI index, but don't worry about what it is. It's just, the thing is that there is, it gets a little frothy up there, more than I would like to see. But when you have a market like we have, you can have to expect it. I don't approve it, but I won't recommend it, but they do it. Okay, here's one of the keys of what's going to be happening. Corporate cash. It's going to come flowing back into this country. Actually, it's going to be like a tidal wave. And you can see technology, the blue line is technology, doesn't really show up the colors there. The blue line is technology, healthcare, energy. These are the things where there's a tremendous amount of money abroad. Corporations are going to bring this cash back. And they're going to do the two things I told you. They're going to raise dividends, if they're paying dividends, and most of these companies are, and then they're going to buy back stock. Both of which is going to raise share prices. So, let me give you a little summary. What's going to happen? You're going to have the market do very well in 2018. I'm pretty convinced of that, at least for 6 or 8 months. In 3 months, I'll give you a little better forecast. The economy will do reasonably well, but it's a little bit more fragile. Infrastructure spending, I don't see it. I don't see where it's coming from. And trickle-down economics, some of you are not going to like to hear this, and you're going to throw tomatoes at me later. There's not an economist who's not on somebody's payroll who will tell you that trickle-down economics or supply economics works. Not one. And you don't have to believe me, but I know enough economists, I read enough material, and I can tell you there is no one. And if you don't believe me, this was written by Mark Zandi. Why the job market threatens to be turned too hot for comfort in 2018. Fed officials doubt tax cuts will spur a boom. Evidence shows, these are papers from well-known people. Evidence shows corporate tax cuts do not work. I got plenty more, okay? Plenty more. You got to be careful. You got to be careful. All right, let's talk a little bit about my investment methodology. Patience is a virtue. Volatility is always there. If you lose sleep because the price of a stock went down, you shouldn't be in the market. Okay? Put your money in a CD. I had two clients come in to see me, a man and a woman, her husband and wife. She was panicky. They had each one had $250,000 with me. And she said, I want to go to cash. This was a little way back. I want to go to cash. I'm down $14,000. I want to go to cash. I said, you're making a mistake. The market's coming back. I don't believe you. Okay, I'll take you to cash. Husband said, no, I'm staying in the market. He was also down $14,000. They come back a couple months later, about 3 months later, he's up $16,000. Made the 14 back, another $16,000. She comes and says, I want to go to cash. I want him to go to cash. I said, why? He made the 14 back and he got 16 grand on top of it. The market's going to drop. About a year and a half ago. Market's going to drop. I said, you're making a big... I don't know, I'm going to cash. I put in a CD, I get 1 point something percent. For 5 years. All right. Peace be with you. Never heard from him again. No one in the industry of the stock market has ever been able to accurately and consistently time corrections. I told you that at the beginning. I repeat it now. Wall Street moves 2 steps up, 1 step back. You might as well accept it. The reason the market does what it does is called the new field. They call it a new field. It's been happening for years. Behavioral finance, psychological. This gentleman and he has cash, I have stock. We each believe one is worth more than the other. I want his stock, he wants my cash, or vice versa. We come to an agreement. I give him cash, he gives me stock, or vice versa. We're both happy. We have different utilities for what we're exchanging. Can you forecast that? No. You don't know what his utility curve is. You don't know what mine is. You can't do that. You can't. And now you got tens of thousands of people doing it. Only it's not really tens of thousands of people anymore, because the last time I checked, 37% of the trades in the New York Stock Exchange were done by Goldman Sachs. So what do? Buy stock in Goldman Sachs. I'm not kidding, we did. Sometimes you just have to go with the bull. Okay. Do not fear higher valuations. I'm not going to go through the book, it's on here, but let me read to you the bottom quote. Underweighting equities based exclusively on high valuations has underperformed the strategy of remaining invested. Because the stock goes up in price does not mean you should not be buying or holding it. It's that momentum investing thing again. Bonds. I hate them. The only thing I hate more is annuities. I'm not even going to discuss annuities because if you're in annuities, I can't help you out. I mean, that's like telling me you don't know who Clorox is. Disadvantage of bonds real quick. Rising inflation, you have no inflation protection. Rising interest rates, price comes down, no protection. Bond ratings, they can change, no protection. Bond insurance, well, okay, so the insurance company guarantees you if the company or the municipality goes down the tubes, they'll pay you. Thank God for the people who in Puerto Rico held their bonds. Some of them were insured, some of them weren't. And it's we even get a tax break in Florida. Why would you want to hold these damn things? I don't understand. Guaranteed income? Well, when you have a company that's been raising dividends for 28, 30, 35 years, 40 years, it's not guaranteed, but I'll go along with it. Tax relief? What tax relief? Yeah, okay, so the municipalities give you a little bit of a thing, but big deal. For guaranteed return of principal, sure. You buy a 10-year treasury, okay, today. 10 years, you get paid back your $1,000. You walk in the grocery store to buy $1,000 of groceries. Guess what you're going to be buying? About $660 worth. The rest you lost through inflation. Economic immunity, not true. You know how many companies, how many municipalities haven't been able to pay their bonds? They're trading flat. You want an example right now? Go look at Puerto Rico. They got more troubles, but here's another thing that bothers me, and that's gold. Every time I do a lecture, I mention this because I hate it. Gold only has two purposes. Jewelry for women and some men. I only wear a wedding ring, that's it. Well, I got a watch, okay. So you got me. And for electrical. You can't spend it, it's not money. Let me use a thing I tell, every time I lecture, I tell people this. Ben Bernanke was asked at university, George Washington University by students, I said, why does the Fed hold gold? He thought for a minute, he said, it's not money. Why do they hold it? He said, you know what he said? He said, because it's tradition. Fed's always held gold. There's a good reason. I mean, what are you going to do with the stuff? You can't spend it. You can't forecast it. It doesn't pay interest. It doesn't pay dividends. It's heavy. You have to store it if you take the actual gold, and that's expensive. If you don't, you have somebody else who's charging you a fee. And go and run the numbers after inflation. Run the real numbers on gold and see where you come out. Okay? Enough said. Okay, mutual funds. You get my standards 2 slides on mutual funds. This is done by the Wall Street Journal. They took the top 25%. Okay? 2,862 funds. And they watched them for 5 years. These are top 25%. After 5 years, guess what happened? You were down to 2. 2. And then one more year goes by, and guess what? You're down to 0. 0 out of 2,800 and whatever the heck it was. If the mutual fund managers have flipped coins, roughly 3 of them would have been expected to remain in the top quartile for 5 consecutive years. Flipped coins. Blindfolded monkey throwing darts to the newspaper, you know the routine. That's Burton McHale, I know him, I got his book. One of the areas that's hot is biotech. Be careful. It can be very lucrative, but can also be a problem. It's going to be hot. Venture capitalists into it. A lot of people into biotech. It's a pretty good way. It's an up-and-coming field because of the health factors. There's the index. You can look at it for yourself. You can see it does get volatile. Just a warning. I put it in there just for a warning. Exchange traded funds, we covered that. Why do you want to buy an index? Can't beat it. It all comes down to how you invest, what you invest in, and how do you hold on to your profits. I'll make this real quick. Here's what your goal should be. Now I'm going to have this put on my tombstone one day. I will. Can't think of anything else to put on it. Try to put, you should have spent more time in the office. My wife didn't like that one. Capital gains, 7 to 9%. Dividend yield, 2.5%. For a total of 9.5 to 11.5. That's what we shoot for. This year we did a little better than that. About 22, 23%. Depending on how you want to calculate it. I can show you the exact numbers if you're interested. What do? We only invest in companies that have been raising dividends for 10 or more consecutive years, period. Our universe at that point is down to 273 companies. Okay? That's our universe. We use 4 intrinsic value models. You want to learn about them, take my classes at Lifelong Learning. Free cash flow to equities, free cash flow to firms, discounted earnings, and a dividend discount model, 2-stage. Now we're down to about 100 to 120 companies. That's all we consider. Now I know what you're thinking to yourself. Well, what about Amazon? They don't pay a dividend. Well, what about Facebook? They don't pay a dividend. Tesla, they don't pay a dividend. We do have a millennial portfolio, but different issue, but they're not in the core 40. We have 40 stocks in the portfolio, and they all have been raising dividends for at least 10 consecutive years. The average is 23, 26 years. So we have some built-in insurance. That's what we invest in. That's all we invest in. Those are the only companies we invest in. You need to identify companies like that. Now, you can go invest in whatever you want. It's your choice. It's a free world. Do what you want. I'm telling you what we have found to be successful over the years. Dividend achievers, intrinsic value of individual corporations. We forecast the financials out 5 years using 5 to 10 years of data. And we develop an optimal portfolio of 15 to 20 companies. That's what you should be doing. We use 40 companies. You should use 15 to 20. The average individual cannot follow more than 15 to 20 companies. Not if you do the research correctly. I mean, go ahead and try. I welcome you to try it. Chances are you won't be able to. The other thing is, try to accurately forecast your returns. I had a guy walk into my office, honest to God truth. He comes in and he says, Lauren, I've been doing 15% of my portfolio. That's very good. Compounded. Oh, that's excellent. Can I see it? Shows it to me. I said, well, you know, your calculation's wrong. What do you mean it's wrong? It's wrong. Here's the formula. When we get the book and prove it to you, here's the formula. I run the formula. You know what his return is? 4.65%. He says, you're wrong. I said, okay, you want the book? The book's on my desk. Do you want to see the book? Didn't want to see the book. Not sure you can read. I see on average 16 to 20 people a week, prospects. It is rare, extremely rare, anybody walks into my office and shows me a portfolio they've had for a number of years where the return is greater, compounded return, I'm talking about, compound return, what they call CAGR, compound annual growth rate, is over 5 or 6%. It's just not there. It's rare. I've seen it a few times, but it's rare. Companies likely to do well. Well, let's start off with, I gave you 12 a year ago. And I published how they did. So, I mean, this was not fixed. I gave it to you in January. I'm trying to photograph is a waste of time, man, but I'll tell you what you can do. Go to my website, you can pull it all off and read it. I mean, you can photograph if you want. I don't care. You just won't get a very good picture. This is all public. Anybody can have this information. I don't care. Give it to my competitors. No, don't give it to my competitors. I gave you 12 companies in January of 2017. And I went back and gave you the results in December 31st, 2017. And it did about 30, I forget the number, 34, 36%. This is the actual companies and how they've done, how they did. Caterpillar did a total return of 10.71%. It was great. Okay. I gave you 12 stocks for 2018. I like these companies. Are these part of our core 40? Not all of them. Are they dividend achievers? Not all of them. But this is for the newspaper. I like these companies. They're good companies. Most of them are dividend achievers, not all. Well, I take it back. Take-Two Interactive is, oh, it may be. Where's Jose? Jose, is Interactive in the Dividend Achievers Handbook? Interactive, Take-Two? I didn't think so. Okay, Take-Two is not. But somebody came up to me before the meeting and said he had been to Take-Two for 3 years. He made a fortune. Yeah, it's a good company. Gaming company, by the way. gaming company. Your kids will know about it. Your grandkids, not your kids, grandkids. Look around, it's grandkids. Amazon. Folks, this is the most successful company in the United States other than Apple. And Jeff Bezos is the wealthiest person in the world. I'm not being facetious. He is the wealthiest person in the world. And I saw a chart of all his holdings. The guy's a genius. Also very, very wealthy. Anyway, Amazon's a great company. And you know what? You can shop at home at midnight with your mouse. And 2 days later, it's in your driveway. Gas consumption, 0. And it's fun to shop on Amazon. And the package, my wife says to me, now I know what you do at night. You're shopping. Yeah. I buy everything from Amazon. I'm down from toothbrushes on to you name it. I buy it from Amazon. Microsoft. Great company. I first got into when they went public. I met Bill Gates way back when he was a snot-nosed little kid. I wasn't too far behind. Up until Ballmer, it was a great company. Ballmer came in, I got out. Yes, I knew Ballmer. He tried to hire me. No, thank you. When he left, we got back into Microsoft, never regretted it. It's a great company. Intrinsic value is about $149 versus a $90 share price. It's a standard in our portfolio. Church and Dwight. I put this one in to show you that you don't have to have a sexy product. Arm & Hammer baking soda. Little orange and blue and white box. Goes in your refrigerator to kill odors. And somebody got the bright idea that if you pour it in a cat litter box, it gets rid of the odors. I got 9 cats. Trust me, it works. I've also got 6 dogs, but they go outside. And 7 horses and a parrot. We won't get into that. I do have all those, the menagerie. Oh, now 2 goats. I came home, we got 2 goats. Church and Dwight. Not a great dividend yield, but a reasonable dividend yield. But they've been paying it for 19 consecutive years. They'll keep on paying it. They've got they've developed a number of other products, and they bought some other companies. Current price about $49.95, and we have about a 65 target on the price. I recently raised a target on both that. I raised it on Amazon too, by the way. Consumer's good. Here's some companies we like. I like Hasbro, Smuckers. Smuckers hasn't done too well. Okay, I admit that. They ended the year with a small loss, about 4% in the stock price. Why? Because they had a little problem with coffee. Coffee prices didn't go their way. They bought a pet food division that's doing very well. And their standard grocery products, of which I use 2, jam and peanut butter. No bread, just the jam and peanut butter. I'm on a diet. The thing is they have a position in grocery stores that you can't beat. They've been there forever. They're a great company. They'll come back. I like them. We're holding on to them. AbbVie. Ever see those Humira commercials on television? That's AbbVie, folks. The most successful drug out there. AT&T Verizon. 5% plus dividend. And between the 2 companies, you got 72, 74% of the wireless market. How the heck can you lose? You can't. Okay. If you need help, email me. Put seminar in the subject line. My email address is lauren.rudd@ruddinternational.com. If you forget it, it's in the bottom of my column every single week, twice a week in the newspaper. The slides will be on my website as soon as Dennis over here gets them up, which should be in the next couple days. Maintain a bullish strategy. I don't care what the people at Merrill Lynch tell you, or UBS, or you name your favorite brokerage house. They're going to tell you you need this strategy, that strategy, do this, do that. It's a total waste of time and money. Buy yourself 20 good stocks and sit back and relax. They'll do well for you. That's our disclosure. Covered that real quick. You can go back and read it at your leisure. That's our building. It's no longer called the Gateway Bank building because Center State bought out the bank. Now it's the Center State, but Rudder International is still there in the bottom. We have the whole third floor of that building. It's Bay Vista and 41. 67,000 people drive by it every day. I know that. And that's one of my kitty cats, one of 9, who sits in my lap while I write newspaper columns. So that's basically it.